Can you talk more about how to interpret the better volume indicator? There's probably a conversation on BM on how to interpret the indicator. Not really. So for instance, this magenta color, this is the highest volume per range and the highest volume times the range. So it's essentially, I think it's times the range, yeah. All right, so this breakout or climax is like the highest volume, highest range of the look back period. So that's why this is only going to work on bars that have differing size ranges. So it's not going to work on a Renko bar. It's not going to work on any Renko hybrid bar or range bar or volume bar, obviously. So this is only really going to work on minute charts up to 10 minutes, nothing larger than 10 minutes. And then it can work all right on a tick chart, but not really, not very well. Because, you know, I mean, I say there's 500 ticks per bar. Well, it's, you know, there's going to be 500 transactions, and the number of contracts is not going to vary, you know, widely between one 500 tick bar to another 500 tick bar. But with a 5-minute bar or a 3-minute bar, it does vary, and that's why I'm only going to use minute bars for the rest of my life, because these are the only ones that I can make work. And they're the only ones that make sense to me. They're the only ones that give me the information that I need to make an educated decision on where to trade, when to trade, and what to expect out of the trade. So I can't get that information from any other chart type. I use minute charts and tick charts and volume charts sparingly, and a range chart rarely. Now this is a climax churn, so it's the highest volume per range. Now think about this. So the highest volume per range. I'm going to show you now. Oh, I don't have it on this new computer. Volume per range. No, I don't have it. Oh well. So I was going to show you this volume per range indicator, but what these yellow bars are is a churn bar. A churn bar is the highest volume per range of the past look back period, 15 bars in this case. All right, and then this weak churn, this orange bar, is the highest volume per range of the past 5 bars, as long as it's not greater than this bar. I don't want to confuse you, but just think the churn bar, the yellow bar, is the highest volume per range. So think about this. As we're coming down to a target, and that's one of the reasons why we go along here at this reversal. So as we come down to a target, and the range of the bar is getting smaller and smaller, so we have a decreasing range, but the volume per bar is increasing. What does that tell you is going on? Think about that for a second. We're coming down, volume is increasing, but the range is getting smaller and smaller. That tells you that as we're coming down, it's taking more and more contracts being sold to move the market down. What does that mean? That means that there's more and more buying coming in, right? So as more and more selling volume is coming in, the market's moving less far. So it's not moving as far as it has been, and it's taking more volume to push it lower. And then a lot of volume comes in, the direction shifts, momentum starts to shift, and then we start to turn back up as the volume continues to increase. That is a good sign of a reversal. So at a reversal, you have one of two things happening. All right, you either have say a market's coming straight down and we're making a reversal low. We're putting in a pivot low. All right, you got to understand, if you're having a hard time trading, you have to understand market reversals. Why is the market turning where it's turning? And if you're not using volume, then I don't see how you can make sense of it. I really don't. I couldn't. So that's just my opinion. I don't think it's an opinion though. But so as we're coming, we're making a pivot low. Market volume is increasing. That's telling us that we have a ton of selling still coming in, and the market's not nearly moving as fast or as far. So that means the market is being supported right there. I mean, that should make sense, right? Does that make sense to you guys? So you have one of two. This is what I was trying to get back to. I just got distracted. So you have one of two events happening at a major reversal. You either have, at a reversal low, you either have a ton of volume coming in, ton of buying volume coming in, or you have the selling drying up. Right? That's the only two things that could happen to cause this market to reverse. Either the selling has dried up, and you have the same amount of buying that you had all the way down, so the selling's dried up, so naturally the market starts to drift back up, or you have, let's say, the same amount of selling, but then all of a sudden a ton of buying comes in and it shifts. So you either have selling drying up or a lot of buying coming in. A lot of times you'll see these spike, especially in crude oil, you see these spike lows, so the market will come straight down, then straight back up, then straight down, then straight back up, right? So those usually occur on a very high spike volumes. That's where a lot of selling volumes coming in, right? The public is going short. Everyone's going short, 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 and who's absorbing all of that? The big boys that have a lot of money that can put on very large positions. They're absorbing all of that selling because that's what they have to do in order to put on a big position. They have to buy into weakness, into a lot of selling. So they're buying right at the lows, and then it starts to go up. They start to push it up, and then once they push it up to a point, then the public comes in and pushes it up even further. And when they start to do that, then the big boys are unloading their positions, selling into the strength. I mean, that's what they have to do. I mean, think about it. So that's why you see these spike lows a lot of times, or spike highs. Usually the spikes occur more at lows. They're more pronounced at lows than they are at highs quite often. But then, the second kind of a thing that I look for, rather than just a spike low and then immediately taken off, is that spike low and then a pullback and then the market coming back and testing that previous low. All right, that's the volume divergence, and then testing that previous low on less volume. And that's my favorite reversal pattern right there. All right. So with that, now, Bob, I've been using this pattern for about 5 years. Well, no, that's not true. About 3 years. So long before I ever started working with anyone. I mean, this is textbook stuff. This is, Wyckoff. Linda Raschke talks about this a lot. You can watch her video on Big Mike's where she talks about the price and volume relationship. She talks about this volume divergence pattern. But I mean, really, when you think about it, this just makes sense. I mean, this is how the market works. When you're making a reversal, you've either got a ton of volume coming in and switching it, or you've got the volume drying up, right? So I think once you start to understand these concepts, it just kind of clicks and makes sense. And then rather than being scared to death to go long here, because, everybody's saying, oh, you're trading counter trend, you're crazy. Well, in certain situations you're crazy, but not when you know what the highest probability outcome is, right? So my problem has been figuring out when we're most likely to have a really strong trending day, because a lot of times if we get into a really strong trend, I'll take a couple losers back to back and kind of mess that up if I'm trying to take this kind of a signal where I'm thinking the markets should be making a reversal, but we're just, strong trend in one direction. That's when I can kind of get into a little trouble, but thankfully it's not nearly as bad as it used to be. Now so on the daily chart, you see, so we pulled back to the 61.8, right? And then we reversed off of it, and we had that big down day yesterday. And then all the way down to, what, the 38.2, right? Which was almost to the support low here of this big gap up day. So that's an even better support low there. Not only was it S2 today, a volume divergence near the low of the VWAP, but it was also the midway point between this giant gap and 38.2 retracement of this move. So I would expect to see an open tomorrow above this level with an up day maybe as high as that 102.92 kind of a thing. I mean, don't mark my words, but that's kind of what I would look for. So we'll see if we don't have that gap up tomorrow morning at 9 a.m. Eastern, then we might just roll on over. Who knows? But if we get that gap up, I'd be looking for a big up day. All right, so with that, I'm going to leave y'all with it, I guess. Are there any other questions? I mean, I may as well just turn this into a trading room, huh? All right, you guys, I'm going to call it a day. Well, call it a day. Yeah, right. I'm gonna be done with done with this training session anyway.